Very interesting. Prateek Parekh, Director of Equity and Equity Strategist at Nuvama Instl Equities, with us to talk about the report, to talk about the market at large as well. Prateek, great having you. Thanks for joining in. Can I start off with the micro, Prateek? And just wanting to understand, maybe you got a glimpse of this conversation that we were having with transformers and rectifiers, right? And the whole power sector is in, how do I say, the people are confused because the government targets are stiff. Companies are saying things are okay, but the street fears that there will be some margin contraction for transformer companies, for wind power equipment companies, etc., etc. How do you look at this? Sorry, I'm starting with the micro, but it just ties in well with the previous conversation.
Yeah. Thanks, Neeraj, for having me over. Now, obviously, this is quite a micro point on from a sector perspective. But my 2 cents over here is that if you look at post-COVID, I think what is most unique about the current bull market that we have had post-COVID is the profitability part. In various sectors, we have seen companies see very high margins. I mean, the real theme of post-COVID is margin expansion rather than necessarily big bang demand. I mean, top line growth in over the last 5 years, CAGR is just 10%, which is very similar to pre-COVID. The big swing is on the profits part, where at an aggregate level, profit would have been 20% plus. Now, a lot of this very high margins across various sectors have come to some extent because of supply chains being scrambled up, both globally and on the domestic front. To some extent, premiumization, and to some extent owing to cost efficiencies. If you look at the study on the previous sectors, which saw very high margins in the very early stage of demand recovery, those did not sustain. Whether you look at QSR, whether you look at durables in the early stages, whether you look at chemicals, whether you look at metals, eventually supply catches up and very high margins are very difficult to sustain unless demand revives in a very meaningful manner. So while people are hopeful that these margins sustain at such record levels, but if you go by the experience that we've seen in other sectors, generally all these sectors have had very good margins and profit tailwinds lasting anywhere between 4 to 8 quarters. Eventually, then supply catches up. And if demand is not very supportive, which unfortunately has been the case in most sectors, margins eventually cool down, weighing on multiples and stock returns per se, Neeraj. So I think the main critical driver for these margins to sustain is going to be demand, which right now is somewhat on the weaker footing, is what I would say, Neeraj.
Got it. Okay. Prateek, is that your belief for the markets at large too? Because a lot of people say that while the FI flows are also the liquidity factor, but Indian growth was probably one key reason why you've seen what's happening in Q2 and Q3 and the resultant impact on the markets. And if growth were to come back, things will change. So what's your view of the current correction? Is this the level where you would tell your institutional clients to go out and start nibbling, or would you tell them to wait for a bit?
Yeah. So I think, Neeraj, if you look at the main reason for the correction that we have seen in last 2-3 quarters is the weakening of earnings. If you look at the earnings per se, in F24, we had 8% top line growth, but 20% plus profit growth. We outpaced emerging market earnings by a mile. Emerging market earnings were very weak to contractionary. But what has happened in F25 is that the margin expansion has stalled. I mean, mind you, margins are still holding up at very high levels. But given that the expansion has stalled, the profit growth and top line growth have reconciled, both to single digits. And at the same time, emerging market earnings, owing to a very low base, have also come back. So in some sense, what has happened is that India's earnings premium has condensed very significantly. And as a result, the valuation premiums too have come lower. Because if you look at the last 6 months, the entire correction is more an India-specific phenomena rather than a global phenomena. Emerging markets, if anything, have actually moved up by 10 to 15% in last 6 months at the same time where India has actually corrected. This is exact reverse of what happened in 2023 and 2024. So in some sense, a reconciliation is taking place. To a reasonable extent, I would say that the India-specific reconciliation has somewhat played out. The global uncertainty and the global risk, I think those are yet to be priced in by the markets, is what I would say, per se, Neeraj. With regards to what we are telling clients from a market standpoint, that is have valuation compressed enough for us to go out and buy lock, stock, and barrel? Answer is probably no. If you look at it, valuations on various metrics, whether you look at market cap to GDP, price to earnings, price to book, for a broader market, they are still anywhere between half to one standard deviation plus expensive. At a time where earnings growth is weakening and there is a very serious risk to the very high margins. So to that extent, we are still somewhat on the cautious side. Having said that, we certainly do see opportunities emerging in a few spaces. The most interesting space to us at this point is the banking space in India. The simple reason is that while there as well, the growth concerns remain, but at least the regulatory aspects are getting better. And more importantly, valuations there are quite comfortable and are not really pricing in a big growth recovery of sorts per se, Neeraj. So overall, from a market standpoint, yes, it's still not yet reached a place which is very comforting to us, but there are certainly a lot of pockets where we think the worst is behind, and probably it's worth accumulating some of those spaces per se, Neeraj.
Hi, Prateek, Tamanna here. Interesting take on BFSI, and I just wonder, as a call right now, and clearly no one is, I think, going to advise to come in lock, stock and barrel, but as a call right now, if there was to be some cherry picking to do, would NBFCs, the nature of Bajaj Finance, etc., be there up on your list, or would you stick to large private sector banks? Where are you veering?
Yeah. That's a good question, Tamanna. So I think at the current juncture, I'm more comfortable with the large private sector banks because there I feel as well, they took a lot of brunt of regulatory actions. Valuations there are much cheaper. And most importantly, the risk of credit cost rising substantially is somewhat lower. NBFCs too, incremental actions are turning positive. But I think I would still wait for some time over there before getting comfortable. But within NBFCs as well, there are spaces where value seems to be emerging, like gold loan financiers, some selective rural financiers as well. But I think the bigger delta or comfort as of now lies more in the large private banks, Tamanna.
So large private banks is one space that you could look at. What are the other sectors that seem to have some upside left right now, Prateek, or maybe some potential here? Are you looking at IT favorably at all? Because the core of what was moving IT, say 2 months ago with the Trump administration, etc., has not necessarily changed.
Yeah. So I think we were actually quite overweight IT in 2023 and 2024, and that's added a lot of alpha to our portfolio. We've recently turned from overweight to neutral on IT, honestly, Tamanna. And our main point is that the valuations there have reached post-COVID peak, whereas the growth is still quite soft. So I think to some extent, valuations have run ahead of themselves. Growth uncertainties remain. And to that extent, IT is not the most comforting right now. The other pockets of value that we see emerging are probably in the QSR space, where we think the record low margins is leading to cost efficiencies and improvement in SSGs, and in the chemical space, where at least we think that the worst of the cycle is behind. So our framework right now, in a world where demand is uncertain, there are many disruptive forces at play, is to look at sectors where profit margins are closer to the bottom and valuations are somewhat reasonable, or stocks have underperformed them now. And on that framework, I think private banks, insurance, some NBFCs, QSR, chemicals, these are the spaces that we think fit the bill, and we are more comfortable in those areas per se.
Why chemicals? I mean, I was also hoping, or the hypothesis may have been that Q3 will see decent performance, except for 2 or 3 names. It was a bit of a damp squib, really, in terms of performance in Q3. So is it very, very bottom up in chemicals, or is it top down?
So I think it's a combination of both, Neeraj, I would say. I think the chemicals, the main story is that the worst of demand headwinds and price erosion is behind. Second, over there, a lot of these companies had done a lot of capex in F21, F22, and F23, seeing very high prices. The worst of the capex cycle is behind. And in a lot of stocks within the chemicals baskets, they have meaningfully underperformed. Now, valuations there also are not as cheap as one would probably would love to have, but nonetheless, at least we think the worst of earnings headwinds in this space is behind. And given the underperformance, we feel that on a relative basis, at least, this is a space where one should look to accumulate on every dip per se, Neeraj.
A little, I don't know, thought came to my mind, Prateek, because the whole rage about platform companies, etc., seems to have sort of died down. I'm just wondering if that is one space that you're still seeing a further upside, or is that now a trend that is behind us for some time?
Yeah, again, I think that's again depends on the micro factors and depends from one platform company to other. The rage on platform companies has died down because they are again entering into the whole, entering new spaces which will warrant cash burn or competitive intensity per se, Tamanna. But at least I feel that on a relative basis, that's a space that one should look to accumulate because these companies have demonstrated that even if there is cash burn, the profitability swings are also wide when the consolidation happens. And while there has been correction over there, at least that's a space that from year on incrementally looks a bit more attractive on a relative basis. But here as well, I think one needs to be more bottoms up in stock picking, depending on which platform company is in which stage of competitive intensity cycle per se, Tamanna.
Swiggy is in what stage in your view in terms of further upside?
So see, I think I won't comment on any particular stock, but I think clearly QSR as a segment is one place where competitive intensity is still on the rise. We don't see the signs ebbing over there. So to that extent, the profit forecast or the profitability focus which Street is having right now, I think could get disappointed. So maybe perhaps when these companies end their market share or the land grab phase and move more towards profit making phase, a trend that we saw in food delivery probably a couple of years back, that's where I think the maximum delta will come in these companies per se, Tamanna.
All right. Thank you so much, Prateek, for joining in. Always a pleasure to speak with you. Now, time for a very quick break. On the other side, we speak with Umesh Chaudhary of Titagarh Wagons about their growth